Welcome to Talk Tickers, where we break down the most important earnings calls. Today, we are diving into Li Auto's Q3 2025 results. And wow, what a quarter it was. It ended a huge profit streak and kicked off a pretty radical new vision for the company. So let's get right into it. All right, let's start with a headline number that really shocked everyone, a non-GAAP loss of 0.36 RMB per share. Now, to understand why this was such a big deal, you have to know that analysts were expecting a profit of 0.64 RMB. So this isn't just a miss. It's a complete 180-degree turn that basically reset the entire story for Li Auto. And this wasn't some minor hiccup. That loss officially snapped the company's incredible 11-quarter run of being profitable. You know, for a company that was widely seen as the disciplined, straight-A student in the Chinese EV space, this is a massive, massive turning point. The streak is over. So you might be asking, why did that profit streak end so suddenly? Well, the answer is right here. Deliveries absolutely plunged, down a staggering 39% from last year. And when you sell that many fewer cars, it just hammers your revenue, which fell over 36%. These numbers paint a picture of a company in some pretty choppy waters. Okay, so what exactly drove this massive reversal? Let's go a little deeper inside the numbers to really figure out what happened with their margins and, more importantly, the serious amount of cash they burned through this quarter. And here's where this story gets really, really tough. Vehicle margin, which is a super important number for any car maker, it's basically how much profit they make on each car, it just collapsed to 15.5%. A year ago, that number was almost 21%. Now, management said this was due to costs from a recall and the fact that their factories weren't running at full capacity because of those weak sales. But on the earnings call, management had a really clear message for investors. They basically said, hey, look past all this noise. These are just temporary, one-off problems. They really urged everyone to focus on what they see as the underlying health of the business. And this is the number they want you to focus on. Their argument is that if you strip out those one-time costs from the Li mega recall, their vehicle margin would have been a much healthier 19.8%. Their point is, fundamentally, the economics of building and selling their cars are still really strong. However, and this is a big however, the cash flow statement tells a very different story. The company burned through nearly 9 billion RMB in free cash this quarter. I mean, that is a massive amount of money, and it's a reversal that you really can't just explain away with a few one-time adjustments. That's a serious burn rate. So, faced with all these challenging numbers, what did the CEO, Xiang Li, do? Well, he didn't just stand there and make excuses. Instead, he laid out this incredibly radical new vision for the company's next decade, a complete transformation into what he's calling an embodied AI company. He announced a firm pivot. He said they're moving away from a traditional professional management style and going back to the company's scrappy entrepreneurial roots. He thinks that's the only way they can move fast enough to win in this new AI-driven world. And this new direction is really built on three big choices. First, change the entire organization to be more like a startup. Second, stop thinking of your product as just a car and start thinking of it as a robot. And third, they're going to develop the entire AI system in-house. I mean, that is an unbelievably ambitious pivot. And that product vision, that's the wildest part. The goal here is to transform their vehicles from just EVs into intelligent, proactive robots that actually serve you. Imagine a car that can find a parking spot and park itself, or drive to a charger and charge itself, all while anticipating what you need. It's less of a tool you drive and more of an assistant that works for you. Now, a vision like that, it's not cheap, not even close. It's being funded by a massive 3 billion RMB R&D budget every single quarter. They are betting the entire future of the company on this huge push into AI. The good news is, they've got the money to do it. For now, at least. Li Auto ended the quarter sitting on a massive war chest of nearly 99 billion RMB. That gives them a pretty long runway to try and make this difficult transition happen. So, despite that bold, futuristic, long-term vision, the company's view of the near term is, well, a lot more cautious. Let's take a look at their official guidance and the headwinds they're up against. And yeah, the fourth quarter guidance was a pretty big letdown. Their revenue forecast came in about 25% below what Wall Street was hoping for. So that's a pretty clear signal that the financial pain and the operational struggles, they're not over yet. And you have to remember, they are trying to pull off this massive pivot in the middle of a brutal, brutal market. The Chinese EV space is a bloodbath right now. Intense price wars, new competition from tech giants like Huawei and Xiaomi jumping in, and government subsidies are starting to disappear. It is an incredibly challenging environment to try something this big.
So what does this all mean for the stock? For investors? Well, that brings us to the next call, our take on what to expect from here.
For us, it really boils down to one simple question. Is Li Auto a deep value turnaround story in the making, or is it a classic value trap that's just going to cause investors more pain? You can really see both sides of the argument. The bull case is all about that huge cash pile and the idea that their underlying margins are still strong if you believe management's adjusted numbers. But the bear case is just as compelling. They're burning through cash, the competition is fierce, and their own guidance signals more pain ahead. Look, while that long-term AI vision is really compelling, the near-term risks are just too significant to ignore. You've got the execution risk of this huge pivot, the massive cash burn, and the intense competition. For that reason, our rating for the next call is underperform. What that means is we expect the stock to lag the broader market over the next year to 18 months. We think the market is going to need to see proof. They're going to want to see deliveries stabilize and a clear path back to positive free cash flow before they're willing to buy into this turnaround story. For now, it's a show-me stock. And as always, just a friendly reminder, this is not financial advice. This analysis is for informational purposes only.